Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 1st of October 2020, and we're going to talk about the prospect of higher gold prices in particular as the global economy begins to slow and the US dollar weakens. Yesterday we produced two videos, one entitled Market Response to First Presidential Election Debate, including gold and silver, where we highlighted that gold and silver prices fell back after that debate and slowly started to recover, and then yesterday evening another entitled Andreas Lehnert, the Fed's Disaster Junkie, a little background about the man who heads the Federal Reserve's Financial Stability Department and what his duties and expectations of him are. Now today we're actually covering why gold and silver have begun to rebound again and have moved modestly higher than this week's opening. But first we have to address two factors which are causing the undermining of the United States dollar and therefore the consequent rise in those prices. There are reports out today suggesting that the recovery in the global economy has slowed down and that the pace of revival moving forward is going to prove not only difficult to improve but even maintain. Further, the prospect of a stimulus package being announced by the US Congress, very likely before the November 3rd presidential election, suggests to markets that financial support will be forthcoming, but at the cost of greater expansion of the dollar currency and therefore a devaluation of its worth. Now we shall take a brief look at a report published by Bloomberg this morning and a very quick update from Reuters suggesting what we have said for some time and what we may begin to expect for the remainder of this week. Bloomberg article dated October 1st, 2020, 9:20 a.m. GMT+1. Headline: The global economic recovery is slowing from a bounce to a grind. The best is already over for a global economic recovery that started off at a sprint and is turning into a slog. That's the warning from Wall Street economists heading into the final months of a traumatic year. Some $20 trillion of stimulus from governments and central banks has pulled the world's economies most of the way back to pre-pandemic levels. But for multiple reasons, the last stretch is set to be the hardest. Policymakers could dial back the fiscal support that's been key to recovery, as they've already done in the United States. Temporary job cuts may harden into permanent ones, a worry compounded this week when corporate giants Walt Disney Co. and Royal Dutch Shell plc fired tens of thousands of workers. And the virus itself is spreading faster and forcing governments to reimpose lockdowns as cold weather arrives. We're getting past the phase where we're rebounding from the shutdown, Ethan Harris, Bank of America Corp's head of global economic research, said on Bloomberg Television. Now we're more into the grinding forward phase. All these risks have made investors less bullish than they've been since the early weeks of the coronavirus crisis. The S&P 500 index declined in September after 5 straight monthly advances, and Europe's Stoxx 600 also paired gains. The good news is that the world economy proved more resilient in a global health crisis than many had feared, thanks to a rapid policy response. Governments subsidized incomes and helped companies stay afloat, while central banks cut interest rates and ensured that stressed financial markets remained liquid. One measure of their success, Deutsche Bank AG, which back in May was warning of a 5.9% slide in global GDP this year, now reckons the contraction will be limited to 3.9%. But that would still amount to the deepest slump in generations, and it's not clear how much more governments are willing to borrow and spend to complete the recovery. Fiscal stimulus added 3.7 percentage points of growth to global GDP this year, according to JP Morgan Chase & Co. But the bank's economists expect policymakers to repeat the mistakes they made after the 2008 financial crisis and pivot prematurely to austerity, turning this year's boost into a 2.4-point fiscal drag next year. In the United States, economists have been cutting fourth quarter growth forecasts because they fear that efforts to pass another coronavirus spending bill have stalled in Congress, though a deal remains possible before November's presidential election. In Europe, where the virus spurred leaders to overcome deep disagreements about pooling their budget resources, a historic €1.8 trillion, the equivalent of $2.1 trillion, recovery fund, seen as crucial for struggling countries like Italy and Spain, now faces potential delays. Further dampening hopes of a V-shaped recovery is the accelerating spread of the virus and the absence of a vaccine. Governments are reluctant to go back into full lockdown, aware of the devastation it could wreak on businesses. But many parts of Europe, including the United Kingdom, have reimposed some curbs. With their revenue squeezed, businesses could face problems repaying debts, leading to more bankruptcies, and making lenders more reluctant to extend credit even to viable firms. And the longer social distancing regimes are in place, the more likely it is that companies will decide the drop in demand for their goods or services is a permanent phenomenon, not a temporary one, and shrink their workforce. That's already happening in several industries. In recent days, Disney announced plans to axe 28,000 workers. Shell said it may cut as many as 9,000. And Germany's Continental AG approved a restructuring plan that will abolish or shift 30,000 jobs worldwide. As some pandemic job losses become permanent, the recovery in labour markets is slowing. In the United States, applications for unemployment benefits remain elevated at about 4 times last year's levels, and a key report on Friday will probably show payrolls growth slowed in September. In Europe, the fastest manufacturing growth in more than 2 years in September wasn't enough to prevent continued job losses. According to IHS Markit, companies are focusing on costs given the uncertain near-term outlook. Some countries are at least seeing encouraging virus data, especially China, where the disease first spread. The world's second biggest economy has managed to bring the pandemic under control and get further along the road to recovery than most peers, even if several indicators suggest it's starting to plateau. But there are risks. There are other risks besides the pandemic world economy. Business confidence is at the whim of geopolitics, as the United States prepares to vote and its trade tensions with China simmer. The UK's trade negotiations with the European Union are in flux, with a hard Brexit still a risk. Our base case is still for some improvement in the economy, said Cathy Jones, Chief Fixed Income Strategist for the Schwab Center for Financial Research. We're walking a fine line. Reuters article, dated 1st of October 2020, updated 3 hours ago, which was in UK time 7:47 GMT plus 1. Headline: Gold gains on dollar slide, hopes for US stimulus. Platinum hits more than 1 week high of $908.50. US weekly initial job claims data due at 12:30 GMT. And this article goes as follows. Quote, gold rose on Thursday as an easing dollar and signs of progress in talks for fresh US stimulus measures bolstered the metal's appeal. Spot gold rose 0.7% to $1,898.79 per ounce by 07:07 GMT, starting October on a positive note after recording its biggest monthly drop since late November 2016 in September. US gold futures were 0.3% at $1,902 per ounce. There's a bit of relief that the dollar rally has, for the most part, ended, and it seems many investors are more focused on the headwinds ahead of the global economic recovery, said Edward Moyer, a senior market analyst at Oanda in New York. The dollar index slipped 0.2% against its rivals to hover near a one-week low, making gold less expensive for investors who hold other currencies. On Wednesday, U.S. Treasury Secretary Steven Mnuchin said talks with House Speaker Nancy Pelosi made a lot of progress on the long-awaited COVID-19 relief legislation. Governments and central banks worldwide have rolled out unparalleled stimulus measures to revive pandemic-hit economies, helping gold rise more than 25% this year, thanks to its role as a hedge against inflation and currency debasement. Market participants are now waiting for the US initial jobless claims data due later in the day and the non-farm payrolls report on Friday for clues about the pace of recovery in the world's largest economy. If US job data comes at least in line with expectations, and as long as the wage inflation number is strong, that may be gold negative, said daily FX currency strategist Ilya Spivak. Among other precious metals, silver rose 2.4% to $23.76 per ounce. Platinum hit a more than 1 week high of $908.50 per ounce and was last up at 1.9% at $905.04, while palladium gained 0.8% to $2,323.96. Okay, so we're now at the stage where the ADP figures still have an hour or so to be published, so we don't know what they will reveal. Nevertheless, gold is beginning to peak and stands at $1,898, just shy of that psychological 1900 level, though we suspect it will sneak past that. And silver is currently at $23.75, with of course $24 in its sights. The dollar index stands at 93.82, and UK and European equity markets are generally higher, somewhere between 0.2% for some and as much as 1% for others. So, we await all 3 job reports this week and the progress on any stimulus package, which should then give us a clear path to where precious metal prices are going to head over the course of the next month or two. And of course, the speed of that move. By all means, please share your thoughts below as to what you believe is likely to happen over the next few days. And not forgetting, if you haven't already done so, to subscribe to our channel so that you may receive regular notifications for us after, of course, pressing the bell sign about economics, precious metal prices, and, of course, a small dab of political intrigue. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.